Welcome back to the deep dive. If there's one decision that reliably injects stress into your life, it's getting a new vehicle.
Oh, for sure.
It's often the second biggest purchase you'll make,
Yeah.
and it forces you to lock in a financial commitment that, it impacts your budget for years. It's a maze. The stakes are really high.
It absolutely is a maze because you're not just choosing a car, you're choosing a fundamentally different financial strategy.
Right.
And our source material gives us this comprehensive roadmap. It's designed to bring total clarity. So our mission today is really to equip you with the knowledge to walk into that dealership or, onto that private sale armed with the facts.
So what's the plan?
We're going to break down the two main paths, leasing versus buying, and then give you a step-by-step strategic playbook for successful ownership.
Okay, let's do it. We're going to start by getting right into the heart of the matter, the core financial comparison. We really need to understand the mechanics of what's happening when you sign that dotted line on a lease versus, a loan agreement.
Let's start with definitions. They tell you everything.
Good idea.
So when we talk about leasing, forget the idea of buying. It's just not that. We are talking about a long-term, high-stakes rental agreement. A rental. You pay a fee to drive a brand new car for a specific amount of time, typically 2 to 4 years, and then, in most cases, you just hand the keys back.
And you walk away.
You stop making payments and you walk away.
And buying, which is, the path to true ownership, is exactly what it sounds like. Whether you're paying with cash or, more commonly, financing with an auto loan, the goal is to fully own that asset.
Yeah.
You make payments, you build equity, and eventually the car is yours, free and clear.
And that right there, that brings us to the most crucial financial distinction. It's the one that governs everything else.
What's that?
It's the battle between depreciation and equity.
Okay, this is the financial nugget that truly separates these two choices. When you buy, you're building equity with every payment you make on a loan, even though the physical value of the car is, it's going down. But with leasing, the story is completely different.
It is. When you lease, you are only paying for the difference between the car's initial price and what the dealer predicts it will be worth when you return it.
That predicted future value.
That's called the residual value. And it is the single most important number in any lease calculation. Your monthly payment is simply covering that expected drop in value, plus fees and interest.
So the residual value is basically the floor price the dealer guarantees for the car after the lease. If your payment is only covering the depreciation, then it really confirms that lease payments are just like rent.
Exactly. They build zero ownership stake.
Zero.
But let's dig a little deeper into the financing side, because this is where a lot of people get tripped up. Why is it that putting a big down payment on a lease doesn't really save you money like it does on a loan?
That's a great question. Because, standard financing logic doesn't apply here. When I buy a car, if I put 20% down, I immediately save money on interest because I'm borrowing less. So how does the lease model change that calculation?
Well, in a lease, the interest rate isn't even called an interest rate. It's called the money factor. And while a down payment or capitalized cost reduction, it does lower your monthly payment.
Okay.
It often doesn't significantly change the money factor itself. You are essentially prepaying depreciation.
So if the car gets totaled a month later,
You lose that entire upfront payment, and you haven't saved substantial interest compared to what you would with a traditional loan. It's just a far riskier way to use your cash for a pretty minimal gain.
that's a fantastic distinction to understand. It tells you that if you lease, you should keep your money in your pocket, not hand it to the dealer up front. So let's move on. Who should lease and who should buy?
It really comes down to two things, frequency and mileage.
Okay.
If you are someone who must have a brand new car every 2 or 3 years, you want the latest safety tech, the newest infotainment system.
You love that new car smell.
You love that new car smell. And this is the crucial point. You drive low mileage, say under 12,000 miles a year. Leasing is practically designed for you.
And on the flip side, if you have a long daily commute, if your family takes road trips, or if you just prioritize that long-term financial stability of building an asset, then ownership is really the only path.
For sure, buying gives you total control, especially over mileage, which is a huge relief for people who drive a lot.
Let's quickly detail the trade-offs, the pros and cons.
Okay, on the side of leasing, the pros are very attractive, starting with that lower monthly payment we just talked about.
Right. Since you're only paying for depreciation, the monthly cost for a lease is usually way cheaper than a loan for the exact same car. Plus, they often require low or no down payment.
Another huge pro is maintenance relief. Because you're cycling through cars every few years, all the repairs are typically covered by the factory warranty. You avoid those huge repair bills that hit older cars.
And the exit strategy is simple. At the end of the term, there's no stress about selling a used car or negotiating a trade-in. You just return the car and walk away.
And for business owners, yes, the costs can be easier to write off as a tax deduction, but the cons of leasing are there's severe restrictions.
Right, the mileage cap.
The mileage cap is the biggest danger zone. If the lease caps you at 10,000 miles a year and you drive 18,000, you are facing serious penalties when that lease expires.
And it's not just miles. You can't really modify the car.
No, strict rules on modifications. And if the car suffers damage beyond what they call normal wear and tear, say a big scratch or curb rash on the wheels, you face special fees when you return it.
And the worst part is the rigidity. Life changes. If you need to terminate that lease early because your family grew or you moved, the cancellation fees are famously high.
It's not an easy contract to escape. They essentially demand you pay the remaining depreciation up front.
Now let's contrast that with the ownership experience. The obvious primary benefit of buying is complete autonomy.
Total control. Drive 5,000 miles or 500,000, it doesn't matter. You can install custom parts, change the paint color, whatever. It's yours.
And the flexibility later is invaluable.
Yeah.
Once that loan is paid off, the value is entirely yours. You can keep driving it for decades, sell it, or trade it in whenever you're ready.
And unlike leasing, it is generally much easier to get out of a loan. Paying off the balance early rarely gets you a penalty.
But the major drawback of ownership is, well, the cost.
For sure. You'll likely face higher monthly payments and you'll need a larger down payment. 20% down for a new car is a widely accepted goal to keep that loan manageable.
And while you're building equity, you're also absorbing the pain of depreciation. The owner takes the full financial hit.
That AAA analysis we looked at was eye-opening. It found that the average new car loses, $4,680 every year over the first 5 years.
Wow. That loss of value is unavoidable.
And that pain is compounded by the fact that once the warranty expires, usually right around the time the car is paid off, you're on the hook for every cent of maintenance and repair.
Okay, so if you've decided that building equity and having total control outweighs the pain of depreciation and higher payments, then ownership is your path. Let's move past the decision and provide that strategic blueprint for actually buying a car.
This is where we need to be systematic. The goal is to minimize stress and maximize savings, and our first step is critical. Set your financial foundation before you even look at a single car.
Budgeting has to come first. The sources suggest allocating 10 to 15% of your total take-home pay for all car expenses.
And that's a key word there, all. That means the loan payment, insurance, gas, and estimated maintenance costs all have to fall within that 10 to 15% band.
And that rule needs to be a little flexible. I mean, if you live in a high-cost area with expensive insurance, you might need to lean closer to that 10% end.
Absolutely. And if you choose a used car, definitely budget a higher maintenance buffer because the risk is just greater.
When it comes to financing, the golden rule is always to seek pre-approval. Go to your bank or your credit union first.
Yes. They will often offer you a better rate than the dealer's in-house financing. And critically, getting pre-approved gives you a maximum loan amount.
It gives you a hard boundary.
A hard boundary. It keeps you focused on the car price, not just the monthly payment. And remember, a high credit score is your best friend here. It gets you the best possible rate.
And let's not forget that down payment goal.
Yeah.
20% down for new cars, 10% for used. That immediately helps with that early depreciation hit, and it lowers your monthly payments.
Okay, step 2 is defining your true needs. This is where people get emotional and they buy the car they want instead of the car they need.
You have to be brutally honest with yourself. Where are you going to park this car? Will it even fit? Do you live somewhere you genuinely need four-wheel drive? Or is two-wheel drive fine?
Right. Are you commuting alone or are you shuttling multiple people around all the time?
And once you've defined the need, use the excellent research resources out there, consumer reports, review sites, videos, to understand the real-world pros and cons.
Then comes the non-negotiable step, the test drive. You have to assess the performance, the visibility, the comfort on the road before you commit.
And a quick check. New or used? We already talked about the rapid depreciation of new cars. A used car, even one that's only a few years old, has already absorbed the worst of that value loss. It's just a smarter financial decision for most people.
Step 3, choosing the right seller. This is a trade-off between price and protection.
Private sellers, they offer the cheapest prices because they have zero overhead, but you get zero warranty protection.
So if you go that route,
An independent mechanic inspection is mandatory. Do not skip it.
the dealer provides the most convenience and safety. They offer financing, they handle all the DMV paperwork, and they provide warranty options. That convenience is why the price is higher.
But they also have to provide a federally mandated buyer's guide on all used cars.
Exactly. Then you have online platforms like Carvana and CarMax, which, they reduce that in-person stress. Huge selections, delivery, hassle-free process. They're basically national dealers. And they also have to provide that buyer's guide.
And for those hunting something niche, buying out of state is an option, but it complicates things quickly.
Oh, yeah. You have to deal with transportation, making sure the vehicle meets your state's emission laws, and navigating different state tax policies. It's a headache.
Okay, let's talk about step 4, the art of negotiation. This is where preparation really pays off. It's where you can save hundreds, even thousands of dollars.
What's fascinating here is that negotiation should be separated into 2 distinct stages.
Oh, this is a good tip.
First, negotiate the price of the new car. Second, after that's done, negotiate the trade-in value of your old car. Don't discuss them at the same time.
Why not?
Because the dealer can hide losses on the trade-in by just adjusting the purchase price. You lose track of where the money is going.
That makes sense. So preparation is everything. Before you walk in, you have to know the fair market value of the specific car using reliable sources like Kelley Blue Book or Edmunds.
If you have the facts, you have the power. And the tactic isn't confrontation. Be friendly, be calm, and stick to your facts. Don't let yourself feel pressured.
And the most powerful weapon you have as a buyer
is the willingness to walk away.
Exactly. If you are prepared to leave the lot, you are negotiating from a position of strength, and that often convinces a seller to meet your number.
And as part of that negotiation, you have to look out for those costly dealer add-ons that just magically appear at the final stage.
Ah, yes, the final stage.
This is critical advice. Things like VIN etching, extended service plans, fabric protection, or these crazy high documentation fees, they are pure profit for the dealer.
So what do you do?
Don't agree to any add-ons you didn't specifically ask for. If they say the documentation fee is fixed, ask them to reduce the vehicle price by the same amount. Be rigorous.
Which brings us to step 5, finalizing the deal and protecting your purchase. You have to review every single line of that paperwork meticulously.
Especially when financing. You need to understand the exact loan term, how many months, and whether the rate is fixed, meaning it stays the same, or adjustable.
And if it's adjustable,
walk away. You want a fixed, predictable payment.
Okay, let's spend a moment on the crucial protective steps for used car buyers. This raises an important question. What 2 steps are absolutely non-negotiable when you're buying a pre-owned car?
These 2 steps are your insurance policy against a terrible financial mistake. First, you absolutely must get a vehicle history report, like a Carfax or auto check.
What does that tell you?
It tells you if the car has been in major accidents, had flood damage, or has title issues. Second, and this is even more critical for private or online sales, you have to get a pre-purchase inspection, a PPI.
Done by an independent mechanic who works for you, not the seller.
Exactly. Skipping that PPI is essentially signing a blank check to a future mechanic. You have to know what issues are hiding under the hood that could cost you thousands down the road.
And for private sellers, make sure the legal paperwork is complete. That means a clean bill of sale, the title correctly signed over to you, and an accurate odometer disclosure.
If we connect all of this to the bigger picture, it really confirms that the best choice, between leasing and buying is entirely personalized.
It's not one size fits all.
Not at all. It depends on whether your lifestyle demands high mileage and modifications, or if you value the lowest possible monthly payment and that constant assurance of a warranty. Neither path is universally superior.
Only the best path for your specific situation.
Absolutely. The decision is highly personal, but the execution shouldn't be left to chance. Preparation is the key to minimizing stress and maximizing the value of your car, regardless of whether you're renting or owning.
Here is a final provocative thought for you to mull over. If a brand new car loses nearly half its average MSRP in value due to depreciation over the first 5 years, knowing that, and knowing the significant financial risk you absorb upfront in the purchase, does that inevitable loss make the upfront control of buying still worth the cost when compared to the financial cushion and much lower monthly payments that a simple rental, a lease, provides? Something to consider as you navigate that complex acquisition maze.